The last page of questions is about other asset classes, so property and other asset classes. Gavin asked the question, not me, another Gavin, asked the question about what are exchange-traded funds? So they're talking about these exchange-traded funds and who do they work? I think it means how do they work? Are they worthwhile investment to consider? How do you differ from owning shares outright? Well, exchange-traded funds are getting a lot more money being direct through that investment mechanism. Effectively, they're a progression on a managed fund. Generally, a managed fund is where a group of investors put their money together with a fund manager who's going to manage all their money. And that fund manager goes out and invests the money and provides back a return to those investors. So they're giving their money directly to the fund manager. The manager goes invest it and they get the return. The way that the exchange-traded fund works is it's like that fund, but it's listed on the Australian Stock Exchange. So the difference is that if you wanted to draw some money out of a traditional managed fund, you would have to send a request off to the fund manager. The manager would then send you a check or direct some money to your bank account, and it could take a week, it could take 2 weeks. An exchange-traded fund is basically a managed fund that's listed on the stock exchange, so you can buy and sell it like you can a stock on the stock exchange. It's a lot more timely in terms of buying into the market. And exchange-traded funds can be like index funds, so just representing the top 200 index, but there are other funds as well, exchange-traded funds that do have a particular investment management as well. Exchange-traded funds are good for their timeliness in terms of you're able to buy and sell them on the stock exchange, so you can make your buys and sells quickly. They're good in terms of their fees. They're generally, but you have to check the individual ones, but they're good in terms of their fees. They've generally got lower fees associated with them, but they're not good if you're trying to invest over time because you pay the standard share price, brokerage standard shares, so you might pay $30, and if you're going to invest in it each month, then you're going to pay $30 each month just in the brokerage fees. Whereas with a managed fund, you generally don't pay those fees. So they're another type of investment, but if you're just looking at learning about the investment, investing or wanting to invest some money in your own name, then the likes of a listed investment company like the Australian Foundation Investment Company can provide that sort of exposure and the benefit of also passing on capital gains discounting as well. So in terms of as you progress down the investment process, listed investment companies like AFIC, depending on whether you're regularly investing over time, a managed fund might work, or an exchange-traded fund can be good in terms of timeliness of making transactions and cost effectiveness as well. Hopefully, I've actually wrote an article on it, so I might in the recording provide a link to that exchange-traded fund, a bit more of an explanation about that as well. So what sorts of investments make sense post-GFC? Well, if you think back to that chart, that's a question from Ben. Ben, if you think back to that chart that we looked at earlier, if we say, I don't feel as though we're post-GFC at the moment, but assuming that we were post-GFC and we're not going to go back down to here, investing in growth assets is potentially an advantageous thing because you're going to hopefully see the market return up here. But generally, a diversified portfolio will enable us to get the benefits of a broad range of asset classes. Depending on where you are, as we've talked through the session, having a diversified portfolio, if you've got a longer time to invest, you might be able to weight that more towards growth assets. If you've got a shorter time to invest, then you might weight that more towards defensive assets. Post-GFC, and the pure sense of the question, if you thought we were post-GFC and it was all upside from here, then you would put more money into growth type assets with the idea that you get longer term returns. But you really need to think about both the downside risk and the upside risk as well. Hopefully that answers your question, Ben. Last couple of questions are from Lynn. What about real estate as an investment? Is it worthwhile remortgaging your home to invest in a second property? When investing in a second property, you say, for example, you own your own home, it's debt-free, you want to go and invest in a second property. The way I like to do it is that you save sufficient deposit so that you don't have to mortgage your own home. You just got to mortgage against the investment property. It just creates a level of shelter between risking your family home. Just puts that barrier between risking the home and not. So if you go down that track, it might take a little bit more time to save that deposit that's going to be enable you to invest in the property without mortgaging your home, but ideally that would be the case. So nothing wrong with going out and investing in property, but try and mitigate risks. You can also invest in property through self-managed super funds and borrow to invest in self-managed super funds, but it depends on your circumstances as well. Depends on the amount you're going to invest, and is it worth the setup cost and ongoing cost of a self-managed super fund. But definitely it can be worthwhile. I think I answered a question recently. If you're approaching retirement, I don't think that's a good time to get into debt or remortgage, getting into a mortgage at that point in time. As you're approaching retirement, paying down debt is really a prudent thing to do. So it depends on your stage in life, Lynn. A couple more questions. What is the best way to invest an inheritance? Property, shares, mortgage is already paid off. That's from Kathryn. Kathryn, really important here to decide on your investment structure. So am I going to invest in individual names, joint names, trust, company, or superannuation? Or possibly first home savers account or investment bonds as well. Here's a couple of other options that you should investigate if you're eligible for those or they're suitable for you. Choose the investment structure first and then the underlying investment after that. So if you're closer to retirement, it's potentially through superannuation and a diversified portfolio. You can invest in property if you want to, but you really want to know your stuff. Know what you're getting yourself in for, knowing the risks, understanding those risks. If you've got a long term to invest, then shares and property are reasonable. But having some dampener on the volatility with some fixed interest and bonds is useful as well. And finally, is defence housing a sound investment option, Paul? Now that's a question from Paul. Yeah, good question. Defence housing is often promoted and you see being offered. I don't confess to understand them to a high level, to a detailed level, sorry. But the concept is that you're investing in properties that the Defence Force allocates to Defence Force personnel to stay in. And so there's some level of security around the ongoing revenue that you're going to get from them. There are also other arrangements I understand about, servicing those and doing fixing as Defence Force personnel move in and out of those properties. So like any investment that provides a level of security, there are also risks around it as well. So you might have a scenario where things are more secure because the government Defence Force is guaranteeing your rent for a period. But then what happens if the actual Defence Force chooses to close down a particular location where you own the property? Or what if they change the rules? So it can provide a more stable level of return, but there are risks associated with every investment. So I would encourage you to understand the full details of the risks. Talk to somebody else who is invested in those types of investments, and then step back a couple of notches and think about what structure do I want to invest in, what asset classes do I want to invest in, and is it part of a broad portfolio, or am I putting all my eggs in one particular basket? If that was the case, I'd tend to think that you'd go for something a little bit less concentrated in terms of your risk. Now that basically concludes the presentation.